Good evening, and welcome to Truth Report. I'm Alex Truth, and tonight we are following the money across 3 continents, from the crumbling commercial property markets of Hong Kong, to the chaos factories of Washington, D.C., to the crypto ATM machines sitting in gas stations and convenience stores across Massachusetts, where elderly Americans are being scammed out of their life savings.
I'm Maya Clarity, and what connects these 3 stories is a pattern we keep seeing on this show: when institutions fail to do their jobs, when regulators look the other way, and when powerful actors exploit uncertainty for profit, it's ordinary people who pay the price. Tonight we've got a lot to unpack, so let's get right into it.
We're going to start in Hong Kong, where S&P Global Ratings just dropped a report that should have every commercial property investor in Asia reaching for the antacids. Then we'll cross over to Wall Street, where the so-called normalization of political chaos is creating a ticking time bomb for global markets. And we'll close with a devastating lawsuit out of Massachusetts that exposes how one of the world's largest crypto ATM operators allegedly knew its machines were being used to facilitate scams and did nothing to stop it.
3 stories, 3 continents, 1 theme. The people at the top are either asleep at the wheel or profiting from the wreckage. Let's dig in.
Alright, our first story tonight takes us to Hong Kong, where the commercial property market is in what can only be described as a slow-motion collapse, and the banks that are exposed to it are starting to feel real pain. S&P Global Ratings published a report this week with a headline that should alarm anyone paying attention. Quote, "More collateral pain is likely this year for Hong Kong banks."
Let's break down what that actually means for people who aren't steeped in banking jargon. When a bank makes a loan for a commercial property, an office building, a shopping mall, a warehouse, it uses the value of that property as collateral. If you default on the loan, the bank seizes the building. But here's the problem: if the building is now worth significantly less than when the loan was made, the bank is holding a loan that's larger than the asset backing it. That's called being underwater, and it's a very dangerous place for a bank to be.
And according to S&P, the value of these collateral assets in Hong Kong has been declining steadily and is expected to continue declining through 2026. This isn't a blip. This is a sustained, multi-year downturn in Hong Kong commercial real estate, and the critical detail from the report is that the sector, quote, has yet to find a clear bottom. That means nobody knows how much further values could fall. We could be halfway down, or we could be a quarter of the way down.
The South China Morning Post's reporting on this highlights a crucial distinction that S&P makes in the report. While the larger Hong Kong banks have diversified portfolios and deeper capital reserves to absorb these losses, it's a subset of smaller banks that could face, in S&P's words, more acute strain. And that's a polite way of saying some of these smaller institutions could be in serious trouble if this downturn deepens.
Now let's put this in context, because this didn't happen overnight. Hong Kong's commercial property market was once considered one of the most resilient in the world. Office space in Central District commanded some of the highest rents on the planet. But a combination of factors has been hammering this market for years. You had the political unrest in 2019, which shook business confidence. Then COVID hit and accelerated the remote work trend. Then the national security law drove out multinational firms who relocated regional headquarters to Singapore and Tokyo.
And layered on top of all of that, you have China's broader economic slowdown, the property crisis on the mainland that took down giants like Evergrande and Country Garden, and a general pullback in cross-border investment flows. Hong Kong's commercial property sector is caught in a perfect storm, and the banks that lent aggressively into that market during the boom years are now left holding loans secured by assets that are worth less every quarter.
Here's what really concerns me about this story. When S&P says smaller banks face more acute strain, they're talking about institutions that are deeply embedded in Hong Kong's local economy. These aren't global megabanks that can absorb a few billion in write-downs and keep going. These are banks that serve local businesses, local developers, local communities. If they start failing or pulling back on lending, it creates a credit crunch that ripples through the entire Hong Kong economy.
And the question that nobody in Hong Kong's regulatory establishment seems to want to answer directly is this: what is the plan? If commercial property values keep declining, and the smaller banks keep absorbing losses, at what point does the Hong Kong Monetary Authority step in? What's the trigger? Because right now, the message from regulators seems to be, essentially, we're monitoring the situation. And as we've seen time and again, from the savings and loan crisis in America to the European sovereign debt crisis, monitoring the situation is code for we don't have a plan.
The people who should be paying attention to this are not just in Hong Kong. Global banks with exposure to Hong Kong commercial real estate, international investors with capital parked in the city's property market, and policymakers in Beijing who have staked enormous political capital on the narrative that Hong Kong remains a world-class financial center. If the banking sector starts showing cracks, that narrative falls apart very quickly.
And let's be honest about who ultimately bears the cost here. It won't be the executives at S&P who wrote the report. It won't be the senior bankers who made the lending decisions. It will be the small business owners whose credit lines get pulled. It will be the workers at companies that can't get financing. It will be the pension funds and retail investors who own bank stocks. The pain flows downhill, as it always does.
Alright, let's shift now from the slow-moving crisis in Hong Kong to something a bit more volatile and unpredictable. Our second story tonight is about the financial markets and their increasingly precarious relationship with political chaos emanating from Washington, D.C. There's a widely cited Wall Street adage that says, markets hate uncertainty, and as a new analysis from the South China Morning Post points out, that old saying has never really been accurate.
Right, and this is an important piece of analysis because it challenges a comfortable assumption that a lot of investors have been relying on. The argument goes like this: for several decades, starting roughly in the 1980s, the global economy entered what economists call the Great Moderation, a long period of relative predictability. Inflation was tamed, central banks became more transparent, trade expanded, and geopolitical shocks, while they happened, were generally absorbed by markets without prolonged disruption.
That era conditioned an entire generation of investors to believe that the system was fundamentally stable, that disruptions were temporary, and that buying the dip was always the right call. And for a long time, it was. But the analysis makes a critical point: the Trump administration's approach to economic policy is testing the limits of how much chaos markets can actually absorb and normalize.
And here's where it gets interesting. Markets have, to a remarkable degree, shrugged off things that would have been considered extraordinary disruptions in any previous era. Tariff threats that appear and disappear on a daily basis. Executive orders of questionable legality. Public attacks on the Federal Reserve. The gutting of regulatory agencies. Trade wars launched via social media posts. The market has essentially learned to treat all of this as noise, to price it in and move on.
But the analysis warns that this normalization has limits. There's a difference between markets adapting to a new style of governance and markets genuinely pricing in the risks of that governance. And the argument is that we may be in a situation where markets are doing the former while failing to do the latter. They've become desensitized to the headlines without actually accounting for the cumulative economic damage that erratic policymaking can cause.
Think about it this way. If the president threatens tariffs on a major trading partner every other week, and markets stop reacting to each individual threat, that might look like stability. But underneath that calm surface, businesses are delaying investment decisions, supply chains are being quietly restructured at enormous cost, and trading partners are diversifying away from American markets. The headline volatility goes down, but the structural damage accumulates silently.
And here's the really dangerous part. When markets normalize chaos, they also reduce the political cost of that chaos. If the stock market doesn't crash every time the administration does something erratic, then there's no market-based check on that behavior. The feedback loop that traditionally constrained policymakers: do something reckless, markets punish you, walk it back, that loop has been weakened. And when that check disappears, the erratic behavior tends to escalate.
The analysis draws a historical parallel that I think is really instructive. It points to previous periods where markets were complacent in the face of growing structural risks. The period before the 2008 financial crisis is the obvious one, where risk was being mispriced on a massive scale. Everyone knew the housing market was frothy, but because the system kept functioning day to day, the assumption was that it would keep functioning indefinitely. Until it didn't.
Now, I want to be clear about something. This analysis is not predicting an imminent crash. What it's saying is more subtle and in some ways more concerning. It's arguing that the normalization of political and economic chaos creates a fragile system, one that looks stable on the surface but is increasingly vulnerable to a shock that can't be normalized. And nobody knows what that shock will be or when it comes.
And here's the global dimension. When the world's largest economy and the issuer of the world's reserve currency is governed in an unpredictable manner, it doesn't just affect American markets. It affects every country that holds U.S. treasuries, every business that trades in dollars, every central bank that calibrates its policy relative to the Federal Reserve. The normalization of chaos in Washington is being exported to the entire global financial system, and most of those countries didn't get a vote.
The investors who should be most worried are the ones who think they've figured out how to trade this environment. The ones who've built models based on the last few years that assume the pattern of chaos followed by normalization will continue indefinitely. Because the whole point of the analysis is that this pattern has limits, and when those limits are reached, the unraveling tends to be sudden and severe.
And I'd add that this connects directly to our first story. Hong Kong's banking sector is dealing with a property downturn, yes, but it's also dealing with a global environment where the rules of the game keep changing. When U.S. trade policy is unpredictable, when sanctions regimes shift overnight, when the relationship between Washington and Beijing can change with a single social media post, That uncertainty compounds every other risk that Hong Kong's banks are already facing.
Alright, let's move to our third story, and this one hits close to home for a lot of Americans. The Massachusetts Attorney General has filed a lawsuit against Bitcoin Depot, one of the world's largest operators of cryptocurrency ATMs, alleging that the company knowingly facilitated crypto scams that targeted vulnerable people, many of them elderly, and drained their bank accounts. This story comes from investigative reporting by the International Consortium of Investigative Journalists, the ICIJ, which has been doing extraordinary work on what they've called their coin laundry investigation.
Let's set the scene here, because a lot of people may not even know these machines exist. Bitcoin Depot operates thousands of crypto ATMs, those kiosks you might see in gas stations, convenience stores, laundromats, and grocery stores across the United States. They look like regular ATMs, but instead of withdrawing cash from your bank account, you feed cash into them and it gets converted into cryptocurrency. And that cryptocurrency can then be sent anywhere in the world, essentially instantaneously and often irreversibly.
Now, there are legitimate uses for these machines. But the Massachusetts Attorney General's lawsuit alleges that Bitcoin Depot knew, or should have known, that a significant volume of transactions at its machines were being driven by scams. We're talking about the kind of scams where someone calls an elderly person, impersonates a government official or a tech support agent, tells them their accounts have been compromised or they owe back taxes, and instructs them to go to a crypto ATM and deposit their cash to protect their money.
And the allegations in the lawsuit are damning. According to the complaint, Bitcoin Depot received numerous complaints from victims and law enforcement agencies about scam-related transactions flowing through its machines. The company allegedly had data showing patterns consistent with fraud, things like elderly customers making large, unusual deposits, often at the direction of someone on the phone with them. And the allegation is that despite this knowledge, Bitcoin Depot failed to implement adequate safeguards to protect consumers.
This is the part that should make your blood boil. These are not sophisticated financial actors who got caught up in a speculative bubble. These are grandmothers and grandfathers who got a scary phone call, were manipulated by professional criminals, and walked into a gas station and fed their savings into a machine. And the company that operated that machine, according to the lawsuit, knew this was happening on a systemic level and prioritized transaction volume over consumer protection.
The ICIJ's coin laundry investigation has been tracking this issue across multiple states and countries, and what they've found is a pattern. Crypto ATM operators, not just Bitcoin Depot but across the industry, have been operating in a regulatory gray zone. They're technically classified as money services businesses and are supposed to comply with anti-money laundering laws, but enforcement has been spotty and the compliance standards are often far weaker than what traditional banks are required to maintain.
And here's the structural issue. The business model for crypto ATMs depends on high transaction volumes. These machines charge fees that can range from 10 to 20% or even higher. So every transaction, whether it's legitimate or fraudulent, generates revenue for the operator. That creates a perverse incentive. Every dollar a scam victim feeds into the machine is a dollar that generates fees for the company. Cracking down on fraud literally cuts into the bottom line.
The Massachusetts lawsuit is the latest in a series of state-level legal actions against Bitcoin Depot, and it signals that attorneys general across the country are starting to take this issue seriously. But the question is whether these lawsuits will be enough to change an industry that has been essentially self-regulating in many jurisdictions. State-by-state enforcement is slow and resource-intensive, and the crypto ATM industry has been growing faster than regulators can keep up with.
And let's talk about who's on the other end of these scams. The money that gets deposited into these crypto ATMs doesn't just vanish. It flows into cryptocurrency wallets controlled by organized criminal networks, many of them operating overseas, in jurisdictions where U.S. law enforcement has limited reach. We're talking about sophisticated operations that target Americans specifically because they know the combination of high crypto ATM availability and weak consumer protections makes the U.S. a lucrative hunting ground.
The human cost of this is devastating. We're talking about people who lose $50,000, $100,000, sometimes their entire retirement savings, in a single day. And because cryptocurrency transactions are largely irreversible, once the money is gone, it's gone. There's no bank to call, no credit card company to dispute the charge with. The victims are left with nothing, and the emotional and psychological toll on top of the financial loss is immense.
What makes the ICIJ's reporting so powerful is that it connects the dots between individual victim stories and the systemic failures that enable them. This isn't a case of a few bad actors exploiting an otherwise sound system. It's a case of an entire industry segment that was built without adequate consumer protections, that operates in a regulatory vacuum, and that has financial incentives that are fundamentally misaligned with the safety of its users.
And I want to point out something about the regulatory response, or lack thereof, at the federal level. While states like Massachusetts are stepping up, the federal government has been moving in the opposite direction when it comes to crypto regulation. The current administration has been broadly sympathetic to the crypto industry, rolling back proposed regulations and appointing industry-friendly officials to key positions. So while state attorneys general are filing lawsuits, the federal agencies that could implement industry-wide standards are standing down.
That is a critical point, Maya, and it brings us to the part of the show where we connect these three stories together, because while they might seem unrelated on the surface, Hong Kong banking, market chaos, crypto ATM scams, there's a common thread running through all of them, and it's one we keep coming back to on this show.
The thread is this: we are living through a period where the institutions that are supposed to protect ordinary people from financial predation and systemic risk are either failing, retreating, or being actively dismantled. And in the absence of effective institutional safeguards, the people who pay the price are always the most vulnerable.
In Hong Kong, the banks lent aggressively into a property bubble, the regulators are monitoring the situation, and when the losses crystallize, it will be small businesses and workers who bear the brunt. On Wall Street, markets have been conditioned to normalize political chaos, which removes the last check on erratic policymaking, and when the bill comes due, it won't be the hedge fund managers who suffer. In Massachusetts, a crypto ATM company allegedly watched scam money flow through its machines and kept collecting fees, while grandparents lost their life savings.
And here's the deeper pattern. In each of these stories, there are people and institutions who had the information, the power, and the responsibility to act, and didn't. S&P is warning about Hong Kong banks now, but where were the warnings 5 years ago when the lending was happening? Market analysts can see the risks of normalizing chaos, but the trading desks keep buying. Bitcoin Depot, according to the lawsuit, had the data on scam transactions but kept the machines running.
This is what institutional failure looks like in the 21st century. It's not dramatic. It's not a single catastrophic event. It's a slow, steady erosion of the guardrails that are supposed to prevent financial harm, combined with a system of incentives that rewards those who look the other way. The property lender who makes the risky loan gets a bonus. The trader who ignores political risk and buys the dip outperforms for a quarter. The crypto ATM operator who doesn't ask too many questions about where the cash is coming from generates more revenue.
And until the consequences arrive, everyone looks smart. Everyone looks like they're managing the situation. The reports get written, the risks get monitored, the compliance boxes get checked. But when the music stops, and it always stops, the losses are socialized while the profits remain private. That's not a bug in the system. It's the system working exactly as it's been designed to work.
What gives me some hope, and I want to end on this, is that we're seeing pushback. The Massachusetts Attorney General is not waiting for federal regulators to act. She's using state authority to hold a crypto ATM operator accountable. Investigative journalists at the ICIJ are doing the painstaking work of tracing money flows and exposing the machinery of fraud. Analysts are publishing warnings about the limits of market complacency, even when those warnings are unwelcome on trading floors.
And you, our audience, are part of that pushback. By paying attention, by understanding how these systems work, by demanding accountability from the institutions that are supposed to protect you, you are doing the work that informed citizens in a democracy are supposed to do. These stories are complicated, they're technical, and the people who profit from the status quo are counting on you to tune out. Don't give them that satisfaction.
If you have elderly family members, talk to them about crypto ATM scams. If you have investments tied to Hong Kong or the broader Asian property market, pay attention to what S&P is telling you. If you're an investor who's been comfortably buying every dip, ask yourself whether you've genuinely priced in the risks or whether you've just gotten used to ignoring them.
Knowledge is the best defense against a system that profits from your ignorance. That's what we're here for every week, to arm you with the information you need to protect yourself and hold powerful institutions accountable.
That's our show for tonight. I'm Alex Truth. We'll be back next week with more stories the powerful don't want you to hear. Until then, stay informed, stay skeptical, and as always, demand the truth.
I'm Maya Clarity. Thanks for watching Truth Report. Good night, everyone.